Pundits and politicians speak of the current financial crisis as a crisis of capitalism and laissez-faire, and advocate a return of government. But the reality is that government and its interventions never disappeared. In Washington, 12,000 government employees already work on financial market regulation. The banking industry is one of the most regulated. Irresponsible risk-taking certainly contributed to the current crisis, but that recklessness was subsidized and encouraged by politicians and bureaucrats. Greed is not to blame for the mess. There's always plenty of greed. The question is, what incentives did the greedy face? Politicians greedy for popularity and power created perverse incentives for greedy market participants. The subprime mortgage crisis was facilitated by two sets of policies, each representing interventions into the market for political rather than economic reasons. Number 1. Central banks created excess credit. In order to artificially stimulate the economy after the internet bubble, the US Central Bank, the Federal Reserve or Fed, started to lower its interest rates. Between 2003 and 2005, the main rate was set below 2%, and from mid-2003 to mid-2004, it was lowered to 1%. When inflation is factored in, real interest rates were in fact negative for much of that time. Low interest rates made it cheaper to borrow, and thus easier to consume and invest. That may sound positive, but as predicted by economists Friedrich Hayek, Ludwig von Mises and Anna Schwartz, an easy money policy comes at a cost. It generates artificial bubbles as credit is disconnected from savings. Such policy is comparable to drug abuse. There is always a price. Foolish monetary policy set the stage for the Great Depression in the past century, and a policy of easy money created the conditions for the present crisis. As the central bank pumped up the supply of credit, lenders offered more loans at lower rates. More people bought more homes and home prices were bid up, creating an unsustainable housing bubble. Interest rates were then raised again in 2004, and home buyers who had taken out loans with adjustable rates saw their mortgage payments go up. With higher interest rates, demand for housing started to wane, house prices fell, and speculative buyers could not sell for the prices they had expected. The monetary policy was coupled with announcements from the Fed. While the burst of a financial bubble could not be predicted, in the case of a burst, the Fed would inject liquidity into the economy to counter it. US monetary policy was, we were told, a mechanism to make recessions impossible. That sent a very clear signal to investors and speculators. Profits will go to private parties, but losses will be borne by the public. That created incentives for risky action. That would be bad enough, but another set of deliberate state interventions, this time specifically directed to the housing market, made things much worse and created a general financial contagion. Number 2. Interventionist social policy in the US was formulated to promote home ownership. In 1938, the US government created the Federal National Mortgage Association, Fannie Mae, to purchase mortgages. It was reorganized in 1968 as a government-sponsored enterprise, with the implicit backing of the taxpayers if their products went bad. It created financial instruments or securities that packaged together large numbers of mortgages. Recently, the securities that had been issued against those risky mortgages started to lose their value, especially as those risks had been sliced to be integrated into complex financial products. When a small piece of the financial product went bad, the whole investment became toxic. Because those investments were supposed to be marked at current market value in the company's accounting, a fall in companies' values ensued, generating a downward spiral. Banks saw their ratings fall, which prevented them from borrowing every day on the interbank market to refinance. The crisis spread. Another instrument of government social engineering to encourage widespread home ownership was the Community Reinvestment Act, which passed under President Carter's administration in 1977 and was reinforced in 1995 under President Clinton. Under the pretext of eliminating discrimination, lending institutions were coerced to abandon prudent risk assessment and to make loans based on political pressure, not ability to pay. Those mortgages were then bought up by Fannie Mae and its brother, the Federal Home Loan Mortgage Corporation, or Freddie Mac. Backed by the guarantee of taxpayer money, those two controlled nearly half the market for mortgage-based securities. They were given the social mission of encouraging home ownership beyond what the market itself would bear, with clear annual goals set by the US government. Since 1992, Congress has used Fannie and Freddie to purchase mortgages issued to low and moderate income borrowers. In 1996, the Department of Housing and Urban Development required that 42% of all mortgage financing by Fannie Mae and Freddie Mac go to borrowers with incomes below the median in their area. That number increased to 50% in 2000 and to 52% in 2005. The federal government also imposed quotas for mortgage loans to people with income below 60% of the median in their area. At the same time, the Federal Housing Administration intervened to lower the initial investments, or down payments, from 20% to 3%, and plans were announced to lower them to zero. Mortgage markets were not free in America. Banks were being pushed by the federal government to make loans they would not otherwise have made to people who would not have qualified. Politicians wanted to increase home ownership, but their actions had unintended consequences. Loans were issued to people who couldn't afford them. Free market economists saw the dangers. Cato Institute scholar Professor Lawrence White warned in 2004 about the dangers of pushing interest rates down below what they would otherwise have been, and that if Fannie Mae and Freddie Mac encountered difficulties, there would be much larger consequences for the economy as a whole. The combination of monetary policy with deliberate interventions to promote imprudent credit policies gave rise to a bubble. The marketing of complex, taxpayer-guaranteed securities by Fannie Mae and Freddie Mac contaminated financial instruments worldwide. New interventions magnifying past mistakes, by preventing the necessary adjustments needed to revalue assets whose values were distorted by political fiat, and subsidizing reckless policies, as in the US government's bailout of the insurance company AIG, will simply encourage more recklessness. A market system is a system not only of profits, but of profits and losses. Good decisions should yield profits, and bad ones should yield losses. Interventionism removes the discipline without which markets cannot work. Interventionism breeds crises. Politicians thought they could create rights to cheap money, rights to mortgages, and rights to profits without risk. We are paying the price now. Let's learn the lesson and not repeat the same mistakes. Let's stop the political interventions.